Here's the uncomfortable truth about today's market. Nothing actually broke. Microsoft didn't collapse. Gold didn't fail. The economy didn't suddenly fall apart. And yet, everything moved like something snapped. This morning, Microsoft led a sell-off that dragged the entire tech sector lower. The Nasdaq slid with it. At the same time, gold surged to fresh highs, only to reverse hard, almost mockingly, hours later. If you're confused, good, because this wasn't panic, it was repositioning, and that's far more revealing. Let's start with Microsoft. For years, Microsoft has been the market's adult in the room. Predictable earnings, AI leadership, cash flows so steady they barely feel real. When investors want safety inside tech, they hide here. So when Microsoft sells off first, that's not fear, that's a signal. It tells you big money isn't running from tech, it's rotating out of certainty. The Nasdaq followed because the Nasdaq is built on the same story. Future growth, future margins, future dominance, and futures don't like higher interest rates, tighter liquidity, or even the possibility that expectations have gone too far. This wasn't about bad news, it was about good news being fully priced in. Now, zoom out. While tech slid, gold spiked fast, aggressive. Headlines lit up, new highs, safe haven demand, inflation fears, central bank uncertainty, the usual script, except the script didn't finish because gold didn't stay there. It fell back almost as quickly as it rose. That whiplash matters more than the high. Gold isn't just an asset, it's a mood ring for trust. When gold surges, it means investors are hedging against something they can't name yet. When it drops right after, it means they're unsure whether that fear is real or premature. Today's gold move wasn't conviction, it was anxiety without direction. And that's the theme tying all of this together. Markets right now aren't trading reality, they're trading expectations of expectations. Microsoft sells off not because it's weak, but because it's crowded. Everyone already owns it, so the only way to reduce risk is to trim what feels safest. The Nasdaq drops not because growth is dead, but because growth has become expensive. Gold spikes not because disaster is here, but because investors want an insurance policy, then immediately question whether they overpaid for it. This is what late cycle uncertainty looks like. Not crashes, not euphoria, rotation, hesitation, and sudden reversals. It's a market constantly asking itself, are we early or are we late? And here's where the irony kicks in. Retail investors often wait for clarity. Institutions sell because clarity hasn't arrived yet. By the time the story is obvious, the trade is gone. That's why days like today feel illogical, because they're not driven by fundamentals alone. They're driven by positioning, risk limits, and the quiet realization that everyone is leaning the same way. So what's the bigger implication? It's not that tech is over. It's not that gold is broken. It's that the market is losing patience with certainty. The easy trades are crowded, the narratives are tired, and capital is becoming restless. When leadership stocks start wobbling and safe havens can't hold gains, it tells you something important. The market doesn't know what the next regime looks like, and when the market doesn't know, it tests everything. So here's the question worth sitting with. If even the safest stocks are being trimmed, and even the oldest hedge can't hold conviction, what does safe actually mean in the next phase of this market? Because whatever the answer,